if the global economy is going to face a recession in 2H 2024, then for an economy like Korea, it would make sense for growth to come under pressure. Hi there, my name is Ritika Mankar. I work as a senior strategist on board the Global Investment Strategy Service at BCAresearch. So I think the best way to think of Macro Quant is that it creates a beautiful synergy between the best of what we have available from a quantitative perspective and what we have available from a qualitative perspective. So since BCA was founded in 1949, one of the big advantages is the fact that it has long-term data on a whole lot of series that a lot of other people end up focusing on only from a short-term perspective. So the quantitative piece is really strong because we rely on long-term time series data with respect to key macro and market variables. The quantitative piece is also really strong because at BCA we run close to 17 independent strategies, and the qualitative piece relating to Macro Quant was created after interviewing our top strategists so that we know how to use and leverage this long-term data that we have on a range of market and macro variables. So that's the best way that I can put it. Macro Quant combines the best of what BCA has to offer, both from a quantitative and a qualitative perspective. So the way Macro Quant has been designed by definition has been made in a way that retail investors can really use it to generate signals in terms of whether you should be bullish or bearish on a certain asset class. Basis all the long-term time series data which we have on the market as well as on macro variables, we use it to generate bullish and bearish signals for each asset class, and this is something that can be leveraged by any investor, particularly retail investors, in figuring out whether they should be long or short a particular asset class. So I think what we've been able to do is quite special to the extent that the popular understanding is that quantitative models lack intuitive basis. So you'll often have quantitative models that tell you that variable X is telling you that you should buy asset X, but it doesn't explain why intuitively does the signal sent out by variable X matter for asset A. So I think the main USP that Macro Quant offers at this point in time is the fact that it is very intuitive in terms of the signals that it sends out, and the explanatory variables that are sending out these signals make a lot of logical sense. So I'd say, that's the really important, unique selling point of Macro Quant that BCA and Hanwha use at this point in time. Right, so I think the bond market is at a very interesting juncture. So interesting is the juncture that the bond market is at that we need to draw a clear differentiation between where bond markets will head on a 3-month horizon and where bond markets will head on a 12-month horizon. I think on a 12-month horizon, the picture is relatively clear. You should overweight bonds from a 12-month perspective and position yourself defensively, because we, in a base case scenario, expect a recession to arrive in the second half of 2024. But when it comes to the 3-month piece, I think it would serve well for investors to not overweight bonds on that short-term time horizon, and this is mainly because we're not completely convinced that the probability of a second wave of inflation is completely extinguished. So till you're able to extinguish that probability, there remains the risk that bond yields and the Fed funds rate surprises you on the upside, and which is why on a 3-month basis, I would recommend that investors maintain a neutral asset allocation to bonds as compared to the 12-month piece, where it would make sense to maintain an overweight. So I think once again we need to break down how we position ourselves from an equity markets perspective on a 3-month and a 12-month horizon. While in a base case, like I mentioned earlier, one should brace for a recession in the second half of 2024, the fact of the matter remains that history has clearly told us that equity markets tend to peak 6 months before a recession. Given that, it's highly likely that even though next year equities disappoint investors meaningfully, in the short term, on a 3-month horizon, equities might actually do far better than what a lot of people are expecting. So I'd say, again, very important for investors to break down how they approach equities basis the holding period in question. If you're looking at generating alpha over a 3-month period, it would pay off to maintain an overweight on equities. But if you're looking at things from a 12-month perspective, then a defensive positioning is warranted, and I'd recommend maintaining an underweight on equities on a 12-month horizon. So I think Korean investors should take a leaf out of the overall risk positioning that BCA from a global investment strategy perspective is advising, which is that don't become too risk averse too soon, but on a 12-month perspective, position yourself defensively. So in the Korean equities context, even though Korea has had a pretty stellar run from an equity market perspective over the last few months, I think it would make sense to not go underweight or avoid Korean equities just as yet. If the global equity piece surprises on the upside, then a market like Korean equities will also surprise on the upside. So on a 3-month perspective, I would urge Korean investors to stay overweight Korean equities. But the moment it comes to a 12-month perspective, if the global economy is going to face a recession into H 2024, then for an economy like Korea, it would make sense for growth to come under pressure, and hence it would make sense for an emerging market investor to probably maintain a neutral to underweight stance on Korean equities.
That's perfect.
Thank you. Thank you, gentlemen.